Hello everyone and welcome to the channel. Today we're discussing a topic that's raising concerns among many economists: the increasing household debt in the United States and, more alarmingly, the rise in bankruptcies. The situation is worsening, but what are the causes? And what does the future hold? Let's dive in. Let's start with the numbers. According to the latest data, US household debt has surpassed 17 trillion. An impressive figure that continues to grow month by month. But it's not just about the rising total debt. We're also seeing a shift in the composition of this debt. In the past, much of the household debt was tied to mortgages, but now we're witnessing a significant increase in debt related to credit cards and personal loans. This means families are accumulating debt across multiple fronts, with increasingly higher interest rates. Another alarming statistic is the rise in bankruptcies. More and more families are unable to meet their financial obligations, and bankruptcy rates are increasing, particularly in the credit card and subprime mortgage sectors. This trend reflects a bigger issue: inflation, which continues to erode purchasing power, and high interest rates, which are making it harder for millions of families to keep up with payments. As a result, more people are unable to repay the debt they've accumulated. So, what's causing this situation? On one hand, there's the Federal Reserve's monetary policy, which has raised interest rates in an effort to control inflation. On the other hand, wages aren't keeping pace with the rising cost of living. This gap is creating a situation where families are taking on more debt just to cover daily expenses. Another factor is the general economic uncertainty. People are more likely to rely on credit to manage unexpected expenses, but this strategy only works as long as the economy remains stable. In times of crisis, the risk of bankruptcy increases.
The growing debt and rising bankruptcies don't just impact families, they have broader economic consequences. When a significant number of people are unable to repay their debts, banks and financial institutions face difficulties which can lead to problems in the global financial system. Moreover, the increasing household debt means that more resources which could be used for consumption and investment are being spent on servicing debt. This reduces consumer spending and investment, further slowing down economic growth. If this trend continues, we could see an increase in bankruptcies nationwide, with consequences for banks, financial markets, and the global economy. This scenario could lead to an economic slowdown and, in extreme cases, even a recession. On the other hand, if the Federal Reserve decides to lower interest rates to ease the pressure on households, there are risks related to inflation and financial stability. It's a delicate balance that will need to be carefully managed. In summary, the rising concern over US household debt and increasing bankruptcies represents a major economic challenge, not only for the US but for the global economy. The situation is complex and depends on multiple factors, but it's essential to keep a close eye on it. If you want to stay updated on this topic and get real-time insights on economics and finance, make sure to subscribe to the channel and turn on notifications. And as always, leave us a comment with your thoughts. What do you think of this situation? Thanks for watching and see you next time.